Something strange is happening in the American financial markets, and most people are completely missing it. On the surface, everything looks perfect. Stock indexes are flashing green. Headlines are screaming about a recovery. Social media is just flooded with screenshots of profits, big wins, and overnight success stories. It really feels like the American dream is alive and well again. But beneath all that noise, beneath the celebration, the smart money is quietly walking away. And history tells us that when that happens, something big is coming. Let's start with what everyone sees. The US stock market has been bouncing back aggressively. Tech stocks are rallying. AI companies are being valued higher than entire countries. Financial influencers are calling this the next golden era. For the average investor, this looks like confirmation. It feels like we're safe, that the worst is over. But markets don't move on feelings. They move on positioning. And when you look at the positioning, the story changes completely. In every market cycle, there are two main groups. There's the loud money, which is the retail traders, the hype chasers, the social media investors. Then there's the smart money, which includes institutions, hedge funds, insiders, and long-term capital. Right now, the loud money is louder than ever. But the smart money? They're doing the exact opposite. Large institutions are reducing their exposure to risky growth stocks. They're increasing their cash reserves and quietly reallocating their funds into defensive and alternative assets. They're not tweeting about it. They're not posting screenshots. They're preparing. And there's a silent warning signal that almost nobody talks about. It's a signal that almost never lies. It doesn't trend on Twitter. It doesn't make flashy headlines. But when it flashes, the markets listen. That signal is liquidity behavior. Right now, liquidity is tightening. Credit conditions are becoming more selective. And short-term funding stress is quietly on the rise. This means that money is becoming harder to access, even while asset prices are going up. And that combination is incredibly dangerous because rallies that are built on weak liquidity tend to collapse, and they collapse fast. For years, investors have believed one thing: the Fed will always step in. But this time is different. Inflation might look like it's controlled on paper, but the underlying costs for things like energy, insurance, and housing remain elevated. That limits how aggressively policymakers can actually support the markets. If stocks fall sharply, the Fed faces a nightmare choice. Do they protect the markets and risk inflation roaring back? Or do they fight inflation and risk a market collapse? There is no easy exit. And the smart money knows this. The retail trap is already set. Here's how these market traps usually work. First, prices fall sharply and fear spreads. Then, the markets recover just enough to restore hope. Retail investors see this and rush back in, feeling like they're getting a deal. And then, the big players exit into that new demand. Right now, we are in that fourth stage. Retail participation is rising. Options trading is exploding. The appetite for risk is back. This is not how sustainable market bottoms behave. This is how distribution phases begin, where large holders sell their assets to an enthusiastic public. While all the attention is focused on stocks and crypto, something else is happening in the background. Gold and silver are not collapsing. They're not exploding either. They're holding their strength, and that's important. Historically, when precious metals remain firm during a period of equity optimism, it signals hedging behavior. It means institutions are protecting themselves against potential downside while letting their riskier assets run for a bit longer. Silver, especially, is acting strange. Industrial demand for it remains strong. The supply is tight, and its volatility is rising, not falling. This combination usually appears before major market transitions, not after them. The psychological setup for a big move is already in place. Markets don't crash when people are scared. They crash when people feel safe. Right now, fear is low, confidence is high, and risk feels normal again. That is exactly when systems become fragile. Every major financial shock in US history shared this pattern. Optimism returned too early. Warning signs were dismissed as irrelevant. And the losses came faster than anyone expected. And once that momentum flips, the exits just disappear. This isn't 2008. This isn't 2020. This is something much more complex. We have record debt levels, algorithm-driven trading, retail leverage at an all-time scale, geopolitical uncertainty, and fragile supply chains. The markets are more connected and faster than ever before, which means that when something breaks, the contagion spreads almost instantly. There are no slow leaks, no gentle declines, just sudden brutal repricing. So, what are smart investors watching right now? Instead of headlines, professionals are focused on the bond market stress, on credit spreads, on the availability of physical commodities, on currency flows, and on liquidity depth, not just price. And those signals are not confirming the celebration. They're warning of a serious imbalance. Now, let's be clear. This is not about panic. This is not about predicting a crash tomorrow. It's about understanding where we are in the cycle. Smart money doesn't predict. It prepares. And right now, the preparations are increasing. Let's end with a final thought. The market always speaks, but it often speaks quietly. The most dangerous phase of any market, take a look around. America seems to be brimming with confidence. The stock market's climbing, headlines are shouting about recovery, and social media is just a non-stop parade of wins, gains, and people bragging about buying the dip. From the outside, it looks like everything's back on track, like the system saved itself once again. But if you look closer, deep within the machinery where the real money moves, something feels off, very off. And the people who truly understand how these markets work, they're not celebrating anymore. They're getting ready. History has taught us a very uncomfortable lesson. Markets are at their most dangerous precisely when they look their healthiest. Here we are in early 2026, and the US markets are all smiles. The indexes are green, the appetite for risk is back, and optimism is the loudest voice in the room. But a smile isn't always a sign of strength. Sometimes it's just a mask. Behind the curtain, warning signs are stacking up, quietly, almost invisibly, ignored by the cheering crowd. This brings us to the confidence trap. Right now, confidence is everywhere. Retail investors are jumping back in, trading apps are buzzing with activity, and short-term profits are being flaunted all over the internet. The prevailing belief is simple. If it didn't break before, it won't break now. That belief is incredibly dangerous. Why? Because markets don't break when people are scared. They break when people are absolutely sure that every risk is manageable, sure that a safety net will always appear, sure that this time is different. So why is the smart money moving so differently? There's a reason the big institutions don't make a lot of noise during times like these. They don't need the spotlight. They need to get into position. Across Wall Street, a silent shift is happening. Large funds are quietly reducing their exposure to risk. They're hedging their bets, not chasing long shots. Their cash positions are growing, and they're accumulating defensive assets. There's no panic, no big press conferences, just silent, deliberate adjustments. That's how professionals act before a storm of uncertainty hits, not after. Then there's the debt problem that everyone seems to be pretending doesn't exist. The US economy is running on a mountain of debt like never before. We're talking about government debt, corporate debt, and consumer debt, all at or near record levels. Now, debt works beautifully when the economy is growing strong, interest rates are manageable, and money is easy to come by. But when just one of those pillars starts to weaken, debt transforms into a massive pressure system. And pressure systems don't just leak slowly, they snap. This is why interest rates are the real ticking time bomb. Everybody wants lower rates. The markets, the government, consumers, everyone. But inflation hasn't really gone away. It's just hiding in plain sight in the costs of things people don't want to think about. Housing, insurance, healthcare, energy. This puts the policymakers in an impossible position. If they cut rates too quickly, inflation comes roaring back. If they hold them for too long, the economy cracks. There's no painless way out of this, and the markets are slowly starting to wake up to that fact. Another huge illusion right now is liquidity. Everything feels smooth. Prices are moving up. Trades are executing in a flash. But real liquidity, the kind that holds the entire market together during times of stress, is getting thinner by the day. The moment volatility spikes, you'll see what happens. The gap between buying and selling prices will widen, buyers will vanish, trading algorithms will pull back, and selling will just accelerate more selling. That's when everyone discovers the hard truth. Liquidity is always there, until suddenly it isn't. And why does it seem like retail investors always arrive at the wrong time? It's not that they're foolish, it's that they're driven by emotion. They tend to jump in when the fear has faded, when success seems proven, and when making money looks repeatable. Unfortunately, that's also the exact moment when risk is at its absolute highest. Right now, we're seeing retail participation climb again. Options trading is surging. People are taking on more leverage. This isn't what a stable, healthy expansion looks like. This is classic late cycle behavior. While all eyes are glued to stocks and crypto, there's another asset that nobody's really talking about, but they should be. Precious metals, especially silver, are acting strangely. They're refusing to collapse. Yes, they're volatile and noisy, but they are not breaking down. This matters. Historically, when metals hold their strength even while stocks are soaring with optimism, it's a signal that there's serious hedging going on under the surface. It's not about fear or panic, it's about preparation. Every major market shift follows a predictable psychological pattern. First, there's the crisis. Then comes the recovery, followed by a sense of relief. After relief comes confidence, and right after that, overconfidence. Right now, we are somewhere between confidence and overconfidence. People aren't worried about losing money anymore. They're worried about missing out on getting rich. That's the critical shift. And once that happens, the entire market becomes incredibly fragile. This cycle is more dangerous than the last. The markets today are faster, more automated, more leveraged, and more interconnected than ever before. A shock in one area doesn't stay contained. It spreads instantly. A move in the bond market hits stocks. A shift in currency values hits commodities. A liquidity problem hits everything all at once. The firewalls we used to have just aren't there anymore. So what are the professionals really watching right now? Forget the headlines. The real focus is on the subtle indicators: credit spreads, funding markets, commodity availability, currency stress, and the structure of volatility. These signals don't scream for attention, they whisper. And right now, they're all whispering a message of caution. Let's be crystal clear. This is not a crash call. This isn't about spreading fear. This is about awareness. The market could absolutely go higher from here. It often does, right before the end. But when preparation from the smart money rises at the same time that confidence from the crowd explodes, it creates a massive imbalance. And imbalances always resolve themselves, one way or another. Here's a final thought. Loud markets, quiet truths. The most important signals in finance are rarely the ones trending on social media. They don't go viral, they don't feel exciting, and they certainly don't promise fast money. They simply tell the truth. And the truth right now is this: the crowd feels safe, but the smart money feels cautious. And history tells us that when that gap appears, it matters. Imagine this. It's 9:31 a.m. in New York City. The opening bell on Wall Street has just echoed through the canyons of lower Manhattan. Traders are at their desks, coffee in hand, fingers poised over their keyboards, ready for the daily chaos of buying and selling. But today, something is deeply, unnervingly wrong. The screens are on, the numbers are there, but nothing is moving. No green arrows pointing up, no red arrows pointing down, just frozen numbers, blinking, staring back at thousands of confused faces. The market, the very heart of global capitalism, is silent. At first, there's nervous laughter. A trader on the floor mutters, "Just a glitch, happens every few months." It's a common defense mechanism on Wall Street. Assume technology is failing before you assume the system is. But this time, the feeling in the air is different. It's heavier. Because the silence isn't just on the New York Stock Exchange. Within minutes, the reports start pouring in like a tidal wave. Chicago, the hub of commodities trading, is frozen. London, the center of European finance, is paralyzed. Singapore, the gateway to Asian markets, is offline. Futures contracts are locked. Oil prices are stuck. And silver is completely frozen in time. And then, for a fleeting moment, a message appears on a single trader S terminal, a message that no one was ever supposed to see. It's an internal notice from a major US clearinghouse, the plumbing of the financial system. It flashes on screen for less than a second before vanishing, but the trader who saw it will never forget the words, "Temporary liquidity containment protocol activated." No explanation, no follow-up, just those 5 words. And in the hidden language of high finance, those words mean only one thing: someone, somewhere, someone very big, just failed to pay their bill. Panic, cold and sharp, begins to ripple through the system. While the stock market remains a ghost town of frozen numbers, something flickers in the silver market. For a split second, the price flashes, down 7%, then instantly up 11% before locking again. It's a violent, impossible move. For anyone outside the precious metals world, it's just noise. But for the veteran silver traders, it's a smoke signal from a burning building. They know with chilling certainty this isn't about inflation data or the Federal Reserve's latest interest rate decision. This is about something far more fundamental. This is about physical supply versus paper promises. You see, for years, the silver market has been a masterclass in financial leverage, a carefully constructed illusion. For every single ounce of real physical silver sitting in a vault, there were hundreds, maybe even thousands, of paper contracts, futures, options, ETFs, all claiming to represent that same ounce. It's a system that works perfectly, as long as everyone just trades the paper and nobody asks for the real thing. It is like a bank having $1 in the vault but issuing $100 in IOUs. As long as everyone trusts the IOUs, everything is fine. But on this day, something had changed. Someone had just walked up to the counter and said, "I'd like my silver, please." And the vault was empty. What triggered this? The answer lies halfway across the world in a small notice that went completely ignored by the Western media just 48 hours earlier. It was a brief announcement from a Chinese commodities exchange. China, the world's factory, was restricting the export of industrial silver. The official reason given was domestic manufacturing stabilization, a boring bureaucratic phrase. But the unofficial meaning was a deafening roar. China was hoarding. Think about what modern society is built on. Solar panels, electric vehicle batteries, 5G networks, military-grade electronics, medical equipment. Silver isn't just a shiny metal for jewelry and coins. It is an essential, irreplaceable component in all of these high-tech industries. And China, being the world's largest manufacturer, is also the world's largest consumer of industrial silver. So when China stops selling its surplus to the rest of the world, it's not just a market event, it's a strategic move. They were securing their own supply chain, and in doing so, they had just pulled the pin on a global grenade. This is the domino effect that nobody in the mainstream saw coming. Most people think of silver as a niche investment, something your grandpa collects. They don't understand that it is a critical strategic resource, as vital to the 21st century as oil was to the 20th. When China quietly turned off the export tap, the chain reaction began immediately. U.S. manufacturers, who rely on a steady flow of imported silver to build everything from Teslas to iPhones, started to scramble. They called their suppliers, demanding delivery. European industrial giants panicked, seeing their own production lines at risk. And that's when the pressure hit the banks. The big bullion banks, the ones who make billions by selling those paper silver contracts, suddenly faced a wave of clients demanding physical delivery. Not next month, not next week, but now. And then it happened. Quietly, without a single press release or a headline on the news, a mid-sized U.S. bullion bank failed to meet its settlement obligations. It couldn't deliver the physical silver it had promised. And to prevent a chain reaction of defaults that could bring down the entire financial system, the authorities hit the kill switch, the temporary liquidity containment protocol, the market freeze. By the time the financial news channels even started to react, the real story was already over. The damage was done. You saw the headlines later that day. Silver volatility surges amid global uncertainty, or market pauses after technical glitch. But they didn't tell you the real reason why. They never do, because admitting the truth would force everyone to ask one terrifying, system-breaking question. How much of this market is even real? How many of the assets we think we own are just digital promises backed by nothing? Behind the closed doors of power, the story was very different. Emergency meetings were being held at the Federal Reserve, the Treasury Department, and with the CEOs of the major bullion banks. The topic wasn't the price of silver, it was confidence. They knew that if the public, the retail investors, ever found out that you could hold a contract for silver but not be able to get the actual metal, the trust that holds the entire paper market together would evaporate. A run on physical silver would begin, and the paper market, leveraged hundreds to one, would collapse in a matter of days, taking huge banks with it. So, what was their solution? The same one they always use. First, freeze volatility, stop the prices from revealing the truth. Second, delay delivery. Come up with excuses, change the rules,